Welcome back to the Mike Rosehart Show. We're live again for another weekly Wednesday stream. I'm on a brand new phone. I have a brand new iPhone 13. I just got it, just unboxed it. So hopefully things are nice and smooth with the brand new device. So it seems like the camera's working fairly well. Can you guys hear me? Loud and clear? It's a different experience, the 13. Typically I was on the SE2 before your screen, and just a different experience all around. So the Fed today, we were waiting for Jerome Powell to speak today at 2:30. The market was in sort of a unstable free fall, and it was brutal. We were just waiting for any positive news. The market had priced in 0.75% rate hike, and we only got a 0.5% rate hike. But most of the positive rally, I mean, within like the hour following that 2:30 speak, by 3:30, the market was up over 3%. Like the entire S&P 500 jumped. Companies like Starbucks were up 10% on the day. Many other names up considerably on the day. So a 3% jump in the market was a reversal of what we saw on Friday. So it was great to see, a big reversal of the downward pressure and the fear. I'm still, I'm a strong believer right now in staying away from margin, having cash reserves ready. We don't know what is going to happen as they continue to try and tighten. They're not tightening as hard as they said that they would, so that's a good sign for the market. It drove things up. So we're thankful for that. I think a lot of us have been feeling over the last 2-3 weeks a lot of pain as the market straight down. The VIX hit, the Volatility Index hit, I think it was like 36 at an all-time high, or 37 for a bit there, which is, it's like recession level instability and volatility in the market, right? And now we're seeing it was down to 25 today. Hopefully it gets down to 20 again. I'm actually shorting the VIX right now, which means I'm playing the market up. I'm playing that there'll be more stability in the market than there has been, and less volatility than there has been. But suffice to say, we're not having the VIX going back down to like 10. It'll still be, I think, elevated. But yeah, so interest rates are rising. One of the tidbits that was nice that was dropped again today was the focus on personal and core balance sheets being stronger than they've been in previous times. So a lot of the companies are rich, and a lot of the people are rich. The rich are richer than they've ever been, and that's a good sign, right? The rich mostly employ everyone. So inflation is good in some senses for some businesses and people who have lots of assets, right? So the personal balance sheets of the average homeowner are stronger than they've ever been. So that is a good thing. The second piece, and probably more important, is the strength of the U.S. job market right now. It is relatively strong. So the good news about that is that as they tighten, we're not necessarily going to go into a recession. They've got to play a really narrow channel and try to navigate between crashing the market and staving off crazy inflation numbers, right? So they're trying to walk a line. And so right now I'm definitely not bullish on real estate right now. I'm definitely not bullish on the stock market right now. Even crypto is relatively strongly correlated to the S&P 500. So even crypto seems to not be a safe place to be. Where I am confident is using options trading strategies to straddle or strangle or create, spreads where your downside risk is super tight capped and your upside risk is super capped. I don't think we're going to see a lot of volatility. So I think there's going to be a lot of bouncing between certain channels. And you could predict, and you could say, hey, maximum profit is if it stays between these channels. You could set up trades where you have almost no downside. And if you engage in these trades on the frothy ups and the frothy downs, you could potentially just ride with the market and collect what I call an insanity premium. So when people are feeling insane and they're feeling irrational, you get that irrational premium. And so people will pay 200-300%, the next day for something, they would have paid half for the other day, insurance on their stocks. And so you can effectively sell insurance without having to buy the market. You could sell insurance on, with tops and bottom caps, so your stop loss and your stop gain. Now, unfortunately, if the market does rip up, you are stop gained. But our goal here is not to, I don't think we're going to be going into a really strong bull market. There's air being let out of a balloon right now. And so I am, if anything, neutral or bearish. So I would say that it's a great strategy to generate like 1-2% a month right now using strategies like that. You could give up some potential gains that you would have otherwise had, but I will say that it's the way that I'm playing it right now. Lots of cash, staying off margin, and doing trades that give me a lot of irrational premium and theta decay. So that's what I advise in the stock market. In the real estate market, there's a laggard between the lag kind of happens between the market starting to dip, which it is happening. We are seeing less offers. We're seeing more days on market. We're seeing more canceled and expired listings, and then relisting. A lot of that's happening right now. Eventually, there will be lower comps that will register from last month when the market was soft, and some desperate sellers will take those lowball offers and create new comparables. And those new comparables will then generate less FOMO and will then drive the market down further. However, we haven't seen it yet, but we are seeing like a slight bit increase in demand. And what we should see is a spike. So we should see a down and then a spike. And what we need to see in real estate is that spike up. There should be a heat of demand in spring when people want to move. It's typically they do it in the spring after being cooped up all winter. That's when they decide to finally get their house ready for sale and the grass is out and it's beautiful, and especially places where it's snowy. We should see a spike because the rate holds are expiring too. So people have really juicy, attractive, January rate holds at like 1.5%, fixed rate mortgages, 1.59, et cetera, so forth. So we should see a spike. Short term is going to be a bit of a bounce upwards, which is like counterintuitive, right? It's like, why would there be more demand when interest rates are rising? And it's because people want to lock in that cheap debt. Because if a deal cash flows $1,000 a month and you can fix it in for 5 years, you don't care what the price of real estate does. You're buying for long term anyway. You don't, in 10, 15 years from now, you don't care what happens in years 1 to 5 if your plans to sell in year 15. It makes no difference because you're not selling or refinancing during that time. So it literally has no effect. All you care about is what cash flow can I get with my current fixed rate loans. So would I still buy rental properties right now? Yes. I mean, yeah, if it cash flows and you can find something that makes sense, and let's say you could get, last month there were some extraordinary deals on the MLS, better than what a lot of wholesalers were even offering. There were some great MLS deals you could pick up, and rates were still low, and they're getting higher. And if you had a rate hold from before the first half a point increase, potentially you could still have 1 or 2% lower interest rates on the commercial side even, and that could drive your decision to purchase a property. So there is a demand right now, and it can make sense to buy it. I understand why some people are buying. At the same time, we do have some upward pressure on real estate, like despite the fact that rates are increasing, and we will see a downward pressure on real estate in the next year. Like it'll be a 6-month lag. Probably by the fall or the winter is when we'll see more of a pullback, in my opinion. That's, if you look at all the historical data, when we go through a tightening phase like we're doing right now, where interest rates are rising and we're fighting off inflation, it's a lot like what happened in the late 80s, where real estate, like if you bought a house in Toronto in 1991, by 2001, a full decade later, it was worth the exact same amount as you paid for it. Imagine 10 years of no appreciation. That's happened in Canada. Real estate doesn't always just go up. It does over a long period of time with a nice long chart. But you can go through years where it's very flat, years where it's down. There were years where real estate was down 4 or 5% on the year. So it doesn't always go up. Historical cycles show us that we could go through now a bit of a bear cycle. The late 80s, things were going 20% a year. It was going crazy, right? A lot like what we were experiencing the last 5 in real estate and the stock market. They seem to be strongly correlated together. And it makes sense, right? If your stock portfolio is frothy, you're going to diversify a little bit of those gains that you got from Tesla and, whatever, Facebook and everything else as you wrote it up. And you're going to put some of that into real estate, et cetera, so forth. If people are feeling wealthier, they will go a little further on their budgets. Again, lower interest rates just creates a bunch of cheap debt that inflates the valuations on things. So, you can qualify for $1 million mortgage. Soon in the fall, what we're going to see is Canadian qualified for $1 million mortgage will now qualify for like $650, $700 under the new stress testing rules applied with these new higher interest rates that are coming. We should see from December, like we're talking about like 4 or 5 months ago, to this December. I think in that 1 year period, we'll call it January to January, I think what we'll see is about 150 basis points or almost 100% increase in the average cost of a mortgage in Canada. So going from like a 2% mortgage to like a 4% mortgage. Now, some people might be more savvy and they could negotiate like a 3.69 or something, a lot like what we saw 5 years ago when I was investing in real estate more heavily. A lot of my mortgages were at 3.79, 3.89. And the deals, they cash flowed because I was buying 10-bedroom triplexes for 400 grand. Those properties are $1 million now. They don't cash flow at the interest rates from 2015. They just don't. So prices have to fall or rents have to rise substantially. And so what we'll see is rents will come up a little bit. There is still supply demand imbalance that exists. It should create a 6 or 7% appreciation. Over the last 5 years, we saw 30% a year. So we're way ahead of schedule. We could pull back 40% and still be at like a year and a half ago, price wise. So there is definitely room for a bit of a correction. But I don't think we'll see a full blown recession. Real estate prices are too sticky. Most Canadians will continue to hold their home, or they have tons of equity in their home, so they're not overly sensitive to it. And I think the upper echelon of society that mostly owns most of the properties over $700,000, they're wealthier than they've ever been. So it won't be as bad of an effect as it maybe could be. Okay, I'll go to some of the questions here. Brock says, hey Mike, what are your thoughts on reserving your TFSA for Canadian REITs or other distribution income and reserving your RRSP for mostly American dividend paying stocks, funds, and some capital gains? So the tax-free savings account is best utilized to collect interest income or tax unpreferred income. It's not designed for capital gains because capital gains are half tax-free. So you wouldn't really want to do crypto in it. You wouldn't really want to do any stocks in it ideally. Your tax-free savings account should be used to lend. Private mortgages is probably the best tax use for the tax-free savings account because interest income here in Canada is taxed at the top marginal bracket, whether it's in a corp or in your personal name. It's at your top marginal bracket. If it's in a corp, it's automatically at 55%. And you get a credit if your tax rate is lower when you withdraw from your corp, but you're immediately inside your corp taxed at like 55%. So interest income is taxed very poorly. Inside of your TFSA, you can invest tax-free. So if you could get, say, a 20% private second mortgage, you could lend, from your personal account partially as a first mortgage, and then put your TFSA on as a second mortgage on someone's rental property, arm's length, and you could collect 20-25%. Again, I think that REITs are a great example of this too because it's full active business income distributions. Again, REITs are fantastic to hold inside of a TFSA, especially American REITs. Anything that's not tax preferred. In Canada, you get some, like dividends are tax preferred. So holding those like dividends inside your TFSA makes no sense. You want to hold those outside of your tax-free savings account. Now, your RRSP is tax deferred, not tax-free. So you will eventually be taxed on that income, and it will be taxed as income, so not as a capital gain. So there's my understanding is there's no real benefit to again, interest income is still preferred in the RRSP. You get the most tax savings by delaying distribution income or interest income as opposed to dividends or capital gains. They're better outside of those tax vehicles if you're trying to optimize just for tax. Now, I hold shares inside of my RRSP and an RESP and my TFSA as well, but I know that the best thing to do is to not do that. So do as I say, not as I do. I'm not fully optimized. I could be better. For sure. It's just a lot of work to set up your tax-free savings account with someone like Olympia Trust and then find someone to lend the mortgage out to. And it's a bit more active work. I mostly just hold crypto funds inside my TFSA because again, I think that it'll double or triple. And I want that crypto exposure to be tax-free. Again, I know that capital gains are half tax-free already and then half tax your marginal bracket. So capital gains are already a preferred way to earn some money. But yeah, I'm not perfect. So I hope that answered your question. CK, how you doing? Evening, William. Sanam says, opinion on country properties near London overvalued, question mark. So it depends. I think that you can't go wrong owning some land long term. I think land will hold its value, especially depends how close to London you are too. As London continues to grow and expand and we continue to allow more people into Canada, there's going to be the opportunity for London to expand. And so potentially you could sever off a piece of that country property and build more properties. And so when you develop that land, the land becomes more valuable significantly and sometimes exponentially. A lot that might be worth $20,000 an acre becomes worth $400,000 an acre when you use it for developing high-end residential type properties. Yeah, so I would say that there's opportunity. all across the board, I would say properties are currently overvalued right now. So if you can find a property at 80 cents on the dollar, buy it, because you have a cushion for when things correct 15, 20%. Um, in general, I feel like, we're about 2 years ahead of where we should be on the price of real estate. So I could see 2, 3 years from now catching up to current prices. So even if you bought something now and you made a mistake, bought at full price and you didn't get any discount at all, a few years of holding, and hopefully you're cash flow positives, you don't care, you're making money the whole time, and you're back to break even. So it's hard to lose money if you have a good long-term focus in mind. Same with stocks. Like if you own Facebook or PayPal or Amazon, what are the big names that are beat up right now? Netflix, any of those big tech names, you hold those for 5, 10 years, it's gonna be fine. Like Facebook's gonna be fine. Amazon especially, Google, fantastic. The index in general, the NASDAQ 2000 right now is down like, well, it was down 20%. I think it's probably down like 18 or 19% today with the recovery of an afternoon that we had. So yeah, I mean, if you hold long term, you'll be fine. So that's the important thing to remember: is don't panic sell, don't trade. Those aren't prudent investor qualities. You never want to become irrational. You want to have a long-term focus. Get into quality companies and quality properties, quality assets that you can hold for a long time. Now, if you see an opportunity to exit at a great price, that's full market value, and you can take that capital and redeploy it in another asset that's 80 cents on the dollar, or a better opportunity somewhere over here. I've always been a fan of rebalancing your portfolio and selling properties that don't make sense, or acquiring a different asset that's better underutilized. You can take this fully utilized asset, capture that value, and redeploy that capital net of taxes into a new asset that needs to be better utilized. So I'm not a, I don't know what the right word is to say here, but my belief system is that you should be buying quality assets and not be so focused on the trading. I myself have to hold back on the desire to trade, on the urge to want to predict and time the market, because humans in general are not great at timing or predicting the market. So that's something just to keep in mind. 99% of traders don't outperform. So don't trade, invest. And so over a long time horizon, you can beat the market over a long time horizon, but it's very statistically unlikely. You have to catch on to cultural shifts or some sort of paradigm shift, like, as an example, cryptocurrency. Bitcoin's poised to be 100,000 USD token in the next 5 years, like almost guaranteed. Institutional capital hasn't even funneled into cryptocurrencies like Bitcoin. And there's lots of stuff on the blockchain and technology in the blockchain that you can invest in. It's like, to me, it feels like 1995 right now. Actually, you know what? It feels a lot like 1991, coming out of huge inflation, interest rates spiking, real estate's going to go flat or down, stocks in turmoil. There's a chance to invest in Web 3.0, crypto, blockchain, a lot like the internet. That's kind of how, yeah, it feels a lot like we're in the 90s right now. But I'm thankful that we're in today's day and age, because again, we have technology that makes life so much easier and better. And it makes people like me, who grew up with nothing and no connections, I would have had a harder time excelling in the 90s. But today I can get on a webcam and get on a phone and connect to the internet, and at my fingertips is every bit of information that I need at any given point in time. There's a video on almost everything that I need to learn, easily accessible, where that wasn't the case in the 90s. You had to know someone or get connected in. So I would say it's a better time now than ever to be alive. Like, we're so blessed. We're living in an information age as we begin to progress and advance, and we're on the cusp of living, in the next 50 years, science will get us to be able to reverse aging to the point where we might live to be 200 years old. We're going to be on the edge of the best, I think, era of humanity in existence. So I'm happy to be alive right now, and we all should be. We should be thankful that we have these opportunities in front of us, and I don't know, it's blessed. Hey Tyler, how you doing? It says, hey Mike, appreciate the valuable content. What are your thoughts on the DXY? It's been going pretty strong, and I feel some more potential upside. The yen, euro are looking pretty bad in comparison. I honestly don't follow the DXY at all, and I don't trade currencies at all either. So I can't give any opinion at all, other than I will say I think the US dollar I think honestly, like the Western nations in general, as a superpower, an overvalued currency, I think their days are numbered. And I think that we'll see India and China rise in global economic output and power and GDP, just in general, across the board, will outpace and outgrow the Western nations. And so if you're going to bet on any currency, the Chinese currency seems pretty interesting, especially the Indian currency too. They just have so many people, and they're investing heavily in growing the knowledge base of the people that they have. And because they have so many people, they have such mad potential as they go from being a second world nation to a first world nation. So I think there's a lot of potential there in those countries. The BRIC type of emerging markets, I think there's definitely opportunity there for sure. I'm sort of bearish on the US dollar. Again, I'm a crypto guy too. I'm not a crypto guy, I won't say that. I'm bullish on crypto, the technology specifically. I don't know which tokens will be here in 10 years. I think in the NFT space, in the crypto space, probably like 80% of the tokens won't be here in 30 years. They'll just be worth nothing. So be careful. A lot like the internet companies in the 90s, majority of them aren't here today. You only know the success stories, the 5% that succeeded, right? Again, I don't trade, and I don't pretend to trade. I don't know. Majority of Forex traders, currency traders, active day traders do not outperform the market. The best of them, with firms and employees behind them, and insider information even too, degrees in finance, and they spend 80 hours a week honing and perfecting their craft. We cannot, I spend a few hours a day maybe reading some market news. I cannot pretend to ever have an edge, any competitive edge, over someone that spends 80 hours a week and has done this their whole life. I'm not going to spend 80 hours a week. If you're not spending 80 hours a week and you're trading on your phone, you do not have a competitive edge over someone else. You're effectively gambling. So that's my opinions on trading in general. Unless, of course, you're like a theta trader, like you're looking for a decay and you're setting up super smart contracts on irrational days. You have an upside and a downside sort of spelled out. And again, with those trades, I'd always try to be set up so that I'm riding the market up, because long-term the market will ride up. So the worst case scenario is you might get assigned quality company. And we're only trading this on indexes and quality companies. We're not options trading penny stocks. Just stay away from those. Take 5% of your portfolio and play with the penny stocks and the growth stuff. But 95% of your portfolio, maybe we'll call it 80% in blue chip, 15% in mid caps. And by mid caps, I mean $1 billion market cap or bigger, even bigger than $1 billion ideally. And then maybe a little percentage of your portfolio you can play around. But the problem is most people they buy penny stocks and they gamble and they're hoping that they can take 100,000 and turn it into 10 million. And the road to taking 100,000 to 10 million or $1 million is filled with thorns, and the majority of people lose their 100,000 on that path. I'd rather see you take your 100,000 and turn it into 200,000 and do it on a slow, over 7 years or 5 years, and just take your time getting there and not lose your shirt. If you want to put your time in, you can develop a competitive edge buying a business and developing that business. The same is true, I think, in real estate. Is like a business, buying a property and redeveloping it and repositioning it and using leverage, assuming again that return on asset is greater than cost of debt. It's got to be at a point where the cap rates and the return on asset needs to be considerably higher than the cost of debt for it to make sense for you to lever. Otherwise, you got to do cash buys. And so, in some of the major cities right now, like in Miami, you're looking at 6 cap rate is a great deal. 4 cap rate's common. But when you're borrowing, commercial rates right now are 5%. So every dollar you borrow to buy multifamily, New York, LA, Miami, Vancouver, Toronto, you're actually losing money. The only upside, you'd be burning more cash flow. The only upside would be appreciation, which again, I'm not bullish right now. I think we're gonna be flat. Buying deals 70 cents on the dollar, yeah, we jump in those, we turn those around, we make a profit. That business can continue to operate in a flat market. The speculator's business, that dies. So don't be a speculator, be an investor, be a value add investor. That's how you protect and grow your assets. And the most important rule of investing is Warren Buffett's don't lose money. Invest in quality assets that don't lose money. So remember, if you lose 50% on an investment, you need 100% to come back. And if that investment is levered and you lose 50% and it's even over 2 to 1, you're now 50% loss becomes 100% loss. You can lose everything. You're back at 0. And that's much more painful than any other poison I can think of from an investing perspective. Next question. David says, Mr. High inflation world, would you look to a province with no cap or rent increases as a landlord? Yeah, I think that I do believe we will get inflation under control to a degree. So there is that. So I think inflation will come down, but it'll be painful and it will drive cap rates and prices down. I think that as a landlord, I have no interest in renting out properties long-term here in Ontario. Tenants have all the power. And so I am very skeptical to sign a lease or to put a tenant in power of my property, because the way that the government, this NDP, communist, liberal coalition that is currently in majority government power in Canada is, very focused on putting the power in the hands of the bottom 50%. And that's a scary proposition. I think that leads ultimately to less innovation and growth and an overall worse economic output, even if it's better for the short term for some of the people who are suffering most right now, who maybe can't pay rent, et cetera, so forth. It's not good for things long term, and it does a lot of damage long term. So I'm overall, I would say yes. Find cities that it makes sense to invest in, where as a landlord you can run a business that can pass inflation on. As an example, in Florida, if you have a tenant that's month to month, their lease ends after the year and they go to month to month, you can just raise rent 40%. You say, hey, your rent's up 40%, pay it or leave. It's as simple as that. In Canada, we couldn't even raise rent during COVID. Now we get 1%, 2% inflation increases. It's a joke. It's just, you can fall way behind really quick. And that's why you have buildings that people have had for 10 or 15 years and their rents are half of market value. Even if they can keep up the 1 or 2% inflation CPI allowances we're allowed to increase as a landlord, you fall behind real quick. So it's it's something to be careful of and weary of as an investor. We got a super chat. Thoughts on rebalancing real estate portfolio. I have 3 properties total and a duplex with a loan of $180,000 worth $300, but appraisers deny my equity. Should I sell to buy bigger properties? That's a great point. It's come up several times here on these streams and on my channel in general. Should you rebalance your portfolio? Yes, you should rebalance your portfolio. Every year you should pick your worst property or your worst performing asset, dump it and reallocate into something better. It's not a great tax strategy, but just in general, it's very prudent to prune out the weeds, so to speak. And if you can take a property and sell it at 100% or 100 cents on the dollar, and you know how to acquire properties at 80 cents on the dollar, you should be recycling those properties and buying something better. If I can sell my property right now for $500,000 and I can buy a comparable property, and let's say I know how to find a really good deal for, like, say $400, I should sell mine for $500 and buy the exact same thing for $400. Now I might have to spend $30,000 to get them completely comparable. I'm gonna have to do some things to make them a little bit better. But if I can get that gap, let's call it $430 after the $30,000 investments, or your $430 to $500, you have a $70,000 gap there. Potentially it can make sense to cycle into a new asset, especially in the US where you have a 1031 exchange. So there's no real issue with, as you get bigger, you can continue to sell assets tax-free and defer that capital gain. In Canada, you pay tax when you sell. So there is a tax consideration to that super chat question you've asked. Sounds like you have a lot of equity in the property based on the numbers you just gave me. If that's what you can sell your property for at market value, and an appraiser's coming in and telling you it's worth $200, maybe you need to work on the approach with the appraiser. Are you providing those comps to the appraiser? Are you making the property look good and cleaning it up before the appraiser comes in? There's so many considerations about why maybe you aren't getting that full appraisal. Does the property cash flow too, once you've fully refinanced all that equity out that you've created and got through appreciation, etc., is another question. You have to decide if you're going to keep it or not. And if it does cash flow positive after refinancing the capital out, then that's the preferred way, right? Is to keep that quality asset, if it is a quality asset, and tax-free withdraw, right? If you refinance, pull the capital out, you don't pay any tax, and you've got access to capital to then buy another property. So it doesn't always make sense to sell. It always makes sense to refinance. And if it doesn't, you should sell the asset. So if you have a building you bought for 7 cap rate, and now it's this big building downtown Toronto, whatever, and it's a 3 cap right now, that's what it would sell for in market value. the cost of commercial financing is 4 at least right now, maybe 5. So every dollar you borrow, you're 25% worse than your return on assets. So you don't want to lever up a building like that. And so people message me say, hey, I don't want to lever up a building like that. Why do you own the building? If the bank can't lend you money and it can't generate additional cash flow, if it costs you more to borrow from the bank than the asset can return itself, there's an imbalance. And so I'm short or bear, or I just don't like any of the properties. So I am very bearish on that segment of the market. There are still lots of properties that make sense. I have a sixplex in London, in West London, a beautiful area in Byron here, which is off the market right now. I'm going to put it back on once I've rented it. We have 4 units rented. We have 2 more to go. And once it's fully rented, I can show those cash flow numbers, and it's a financeable property because, again, it's very hard to finance a stable, turnkey, renovated sixplex that's vacant. So once it's rented, you go take it to the bank, and it can qualify on its own. The person doesn't need to qualify for the commercial mortgage because the sixplex, the property will qualify on its own using the income that it has. A property like that, I'm selling it like a 6-7 cap. You can borrow at say 4, then there's a spread there. There's a positive spread, and you can win over the long term with a deal like that. That's something that I don't even mind holding. If it doesn't sell, I'm not in a huge rush to sell it because, again, even if I refinanced it, which I haven't, but even if I refinanced it, I'm still cash flow positive. That's a building that makes sense. It's in a great area. It's a great quality building, fully renovated, fixed up nice, great tenants, market rents. That's something I can hold. It's something that I want to stay in Canada, that I could hold. My vision and goal, someone asked if I'm still thinking to leave the Bahamas. Yes, I do plan to leave. Although I currently have, the market is punishing us year to date. My stock portfolio is down significantly. I had a big recovery day on Thursday, and then again today I had a big recovery day. So it is getting better. I'm not down near as much. I'm down maybe 14% on the one part of the portfolio, and I'm up 20% on the other half of the portfolio. So if you average those together, I'm still up. But the part of the portfolio that's down, I've realized all those losses. So I rolled all those contracts and I locked all those losses in. So I can declare like a $750,000 loss in my corp, and all my gains, I haven't sold any of those shares. I have like oil stocks that are up 70%. They're like Suncor and all the rest. They're paying great healthy dividends still to this day. And I'm like, do I want to sell those and lock in those huge gains and pay tax on that? No. So I sell all my losers and react. Like I get back into tech again, just in a different way. After 30 days, you can get in. You can use options contracts actually to get back in and have exposure to those stocks while realizing a stock loss. So yeah, it's currently I'm not motivated to leave Canada because I have a huge operating loss. So I have time. I may stay in Canada for another 2 years until things come back, and I can use those losses to pay no tax. So why would I not stay in Canada if I have losses to offset gains? But effectively, when I leave, whenever I decide to do that, there'll be an exit return, and I'll have to pay a huge tax bill to leave. So that's the stick on the way out. Canada's like, we're going to tax everything you have and take a piece on the way out. But yeah, there are some really interesting strategies I've been reading about online where you can use like a Bahamas Corp to invest into Canada. And if it's an active business in Canada and you're investing with someone, I could invoice for my Bahamas Corp and be a Bahamas non-Canadian. I'm not a tax resident in Canada once I set that up. So in theory, I could bleed money out of Canada into a Bahamas Corp. Bahamas Corp pays almost no tax. So there's ways to still invest as a foreigner, especially in commercial real estate. So yeah, there's definitely opportunity there, and I'm excited about that. And spend my time between probably Florida a lot of the time too, just because it's so close to the Bahamas. That would be where I'd spend at least a third of my time traveling. Daniel says, hi Mike, for a London real estate investor, what's the maximum amount they should be paying per unit nowadays for the deal to make sense? And it's hard for me to say there's like one number that just makes sense. Each deal is different, right? Even different segments of deals. If you're buying a Hamilton and Egerton bummy East London property, you should expect maybe $1,000 a door in cash flow for it to make sense, or $500 a door. But if you're buying in like prestigious West London and Byron, where all the houses are average $1 million, and everything's really expensive, then you might be happy in an A+ location getting $50 a door in cash flow, right? Because you're gonna get more appreciation, and just in general, it's a better caliber of tenant. The shitty East London property might generate you $500 a month in positive cash flow, but then when the tenant profile isn't as good, and one of the tenants eventually trashes the unit. You lose $30,000 to a huge renovation on the property, or the depreciation on it over time is a lot heavier on the property as well. And you're just dealing with more bullshit too, like like theft, and I don't deal with that in my nice properties. There is no theft. The east properties that I had, like, we'd have break-ins at least once a year. Someone break into a house or break into the shed and steal shit. Especially if you're near a beer store in the east of town, you just get more, what do you call them, like black swan events, sort of, so to speak, in your rental property where those kinds of things happen. And so people don't run their numbers to account for, like, once a year in East London, you're gonna get broken into. They're gonna smash a window and steal shit. Or like the fact that, like, once every 5 years, you go through like 6 tenants, and 1 in 6 tenants is gonna mess the place up. And you don't get that as often or as badly in really good areas of town where you can command an A-plus quality tenant, because the A-plus quality tenant doesn't want to live in this shit area of town. So it just, again, it depends. Is it a student rental? Is it a multifamily? Is it a senior type property? Is it Airbnb? Way different. So if student rental versus a single family rental, you're dealing with a lot of more headache on a student rental than just a regular one family in a house. With the stays there for 5 years versus students turning over every year, and like you have your entire front of your property filled with furniture every year at turnover time. They're just different businesses entirely. So there isn't one general rule of thumb, but I would say in the segment that you're looking to invest, look at comparables, look at cap rates in that area, and make your decision from there. It needs to be comparable to other properties and other cap rates. That's what's important. So in general, if it's an East London property, I want making significant cash flow. If it's a really high quality property right in the downtown on a good street with A-plus tenants, I might be willing to sacrifice on the cash flow because I know it's just so easy. I don't have to put any time in. So my return on time is much, much better. Potentially my return on equity long-term might be better too, because the less depreciation, CapEx, overall the property will stay in better condition and will sell for more down the line. So there's so many considerations. It's hard to make rules of thumb, but there was a rule of thumb we used to use called the 1% rule. Those days are long gone. So the idea was you could buy a $300,000 property that would rent for $3,000 a month gross rent. And that was the rule of thumb that was like, that's sexy enough for me to want to buy. In East London, it used to be 1.5% rule. In the good areas of town, it was a 0.5% rule. Now it's like a 0.25% rule in the A-plus locations. You can still find in decent areas a 0.5% rule, 0.75% rule occasionally. As an example, that sixplex, it's commercial, so it's not really, or it's residential, but it's because it's a sixplex, it doesn't follow the same rules as like a duplex. But that one would rent for almost $10,000 a month, so $120,000 a year. So 10 times income would be worth 1.2 million. So using my old rules of thumb, it'd be worth 1.2 million. But today's market's a little more frothy. I'm asking 1.4 for it. It's still attractive. It's still way positive cash flow. A Toronto investor, would be drooling because you can't find anything in a quality area that generates that kind of return, right? Even in London, it's very, very hard to find. So, the market needs to come back a little bit, I think, for it to be as attractive as it once was. It's not as attractive of an environment as it was a couple of years ago when I was really running at it hard. But it's still an opportunity, and the market is, in some European places, landlords are happy with negative cash flow. So I don't know. I don't know what the right answer is, but you definitely want to make sure you have positive cash flow. That's the way I approach it as an investor. William, how much higher do you think interest rates are 2 years from now? So I think interest rates are higher than they are. So 2 years from now, I think they'll be higher than they are now, but they'll be lower than they'll be at their peak. So I think we'll crank hard into next year, and then I think it'll push us into a sort of recession, so to speak, and they'll have to pull back. But they need to have, they definitely need to have fail-safes in place to be able to bring the market out of recession. It's good that they're raising rates right now so that later they can put them down and add some gasoline to the fire when the fire starts to go out. So it's natural and healthy what they're doing right now, but it's, again, not a bullish sign for the economy in the short term. So quick question, Mike, are you liquidating any of your stocks given that the market may still go down in the near future and then get in at the low? I don't try to time the market, period. I don't have a crystal ball. None of us do. Anyone who says they do, who says they know what's going to happen in the future, is lying. They're guessing. Um, am I taking some money off the table though? Yeah. I personally have a hard time sleeping on those hard, those 3% down days. It gives me stress and anxiety and ruins my day. So I'm pulling some money off the table. I'm on margin really. Um, that may change. If I see an entry point, I might get in. I try not to time the market because I know that I'm not smarter than the market, but I still have fun with it occasionally. So yes, am I pulling back? Yes, but I'm still down significantly. So I'm riding along with the market, so to speak. But yeah, my goal is to get out of margin entirely and be about 20%, 30% cash, 70% deployed in the market. That way I have some ammo if we get into these really deep down days where I can enter the market again. Yeah, that helps. I think all of us should be careful right now. Matthew says, the most value is achieved when you smash that like button. For myself, it happened the moment I hit it. So there you go, guys. Definitely hit that like button. I appreciate it. Obviously, tonight's stream is a little, people like the Fed, what he's talking about. People don't even follow the market for the most part, don't know that today was a big day. But yeah, thank you for that. I feel better whenever I smash the like button too. Good fortune to all that tap it. I answered that question already. I need a different remote for this, different stand. Canadian, but it's hard to find deals. So Jamal says, being hard to find deals, it's about perspective. Deals are easy to find. In fact, right now, deals are easier to find than ever before. So many properties are missing offer date. When an offer date is missed, you have a golden opportunity to come in way under asking or slightly under asking and have no competition. That's huge. So yeah, I mean, now is the last month, I haven't seen this many opportunities since COVID. When it first happened in April, it was as bad as this past April. It felt a lot like COVID. We were in a bit of a bear market, so now's the best time to be investing for sure. If you're looking to score some really juicy deals, if you're going to buy at market value, I still would pump the brakes a bit. I'm not super bullish on the prices, but if you can find a good deal, then yeah. Do you have a bug out plan? I don't even know what that is, a bug out plan. Do I have a plan to leave Canada? Yes. Yes, I do. Oops. On an average non-student rental, do you find your tenants stay? It depends. So when I really push the rents and we get the property managers to push rents to their top of the range, I find if we're going for a good quality tenant can find a deal. They have any landlord will rent to them. So they have their pick of the market. And so they're smart enough to find a good deal on a rental, typically with quality, in mind. So it's harder to retain a really good quality tenant at top rents. So it depends on the type of tenant that I have and the rents that I'm charging. If I give them a little discount to stay, I can retain them a lot longer. It just depends. So I would say the goal is like 2-3 years on I typically like to target young professionals. It's always been my strategy not to want a long-term lifer. I don't want lifer tenants because in Ontario, rents outpace the maximum allowable CPI inflation increases we're allowed to deliver each year. We get to deliver like 1% to 2% rent increases every year. They tell you the amount is like 1.6%, I think, for this year. I had to check. I don't even do any of that. I outsource property management, so I'm not in the thick of it. But I believe it's like 1.8%. It was always around just under 2%, whereas rents were rising like 10%. So every year you cap a tenant, you're 8% more below market. So after 7 years, it compounds to the point where like your rents are almost half of what they could be. So you don't necessarily want tenants long term, but if you're managing it yourself, tenant turnover is a pain in the ass and it's a lot of work. So I can see how if you're managing it yourself, you might give a huge discount to just not have to worry about it. But eventually, at a certain point, you want to have the tenant change over. It's actually a benefit because you get to increase the value of your property substantially. 2 properties, identical in nature. One's $300,000, one's $300,000 bungalow as well. one's rented for $2,000 a month, say 1,000 up, 1,000 down. The other one's rented for 2,000 up and 1,900 down at market rents. This one's worth 400,000 versus this one worth 300,000. And tenants don't understand that. Most landlords don't even understand that. Like getting your property up to market rents actually increases the value. I've seen properties go for 50,000 below comps because it says in the remarks, tenant doesn't want to leave, long-term tenant. That's all they have to say and state how much the rent is. And that's enough to drive property values down because it's so hard to get a tenant out or a series of tenants out of a building that are paying low rent. They're paying low rent, they're getting a deal, they don't want to leave. They know you can't increase it on them. It's nothing you can do. So in Ontario, it's huge value in being at market rents. So yeah. But yeah, it is obviously effort. I don't use a software, I use a Google Sheet to track per tab on each property for my expenses and whatever my rents. But yeah, I actually have sold it before, the two sheets that I use, one to analyze deals and one to track, the two of them $30 each as a package. It's barely worth my time to even like go through the effort to send it to people. But anyway, thanks, Brock. Appreciate the comments. Demand says, where are you finding off-market deals? So even on-market deals right now, there are lots of pocket listings and on-market MLS deals where you go see your expired listings, people pulling stuff off, where you can get deals. I have a duplex. I have a bungalow right now that we just rented out in a decent area west of downtown in an okay area in Manor Park. And upstairs is rented for $1,700 plus, I think. They have a certain utility cap. And then the basement's rented are going to be rented shortly for $1,200-1,300. It's almost $3,000 a month. I think it's around $3,000 a month and around $36,000 in annual income. This cute little bungalow with a like nice walkout, separate entrance, unit up, unit down, 3 and 2 beds, for like in the 500s right now. I would sell that property. And like in the froth of the market in February, that'd be a $600,000 property. So it's wild how much things have come down. Expectations have come down. I also am just like lazy and I love a private sale. So if you're interested in something like that, you want to hook up a private sale, I've got that one that we are going to sell. And yeah, I mean, hit me up. There's deals all the time. Lots of off-market properties. I have been selling off-market properties. People I get to know, like there's just so many realtors and investors that you get to meet that just don't want to go through the stress of putting it on the market. They're just looking for a quick, clean private sale. And sometimes you can shave off a little bit. There's also Kijiji, Facebook, Craigslist, door knocking, the wholesalers. A lot of the wholesalers that are established have big lists of buyers. You don't want those ones because you want the guy who's just starting out as a wholesaler because his buyer list isn't big. And you can go in there and say, hey, would you do it for $10,000 wholesale fee? The established good wholesalers who are large and have been doing this for a while, their buyer list is like 5,000 people long. And so it goes out to every realtor everywhere. And so everyone's seen it. All the eyeballs are on it. Sometimes the wholesalers have better exposure than the MLS. And all the investors think that off-market deals are great. And so they're overpaying for off-market stuff. And I've seen that some wholesalers are getting $150,000 fee and it's selling almost at market value. Like the neighborhood comps are like what it's selling for off-market. I'm like, why don't we just go buy something on market? But anyway, there are tons of opportunities if you know where to look and what rocks to turn over. That's the most high value skill in real estate, is that skill right there. Corey says, any reason you don't do more private lending? I could do more. I may consider doing more. I'm thinking about starting up a lending business, like a Rosehart capital lending arm, where I just lend my own capital for the most part. I've thought about it. I've thought about raising capital too, but I have to be very careful about that. And I could, if I got my mortgage broker's license, I could connect to people. Like I could say, hey, I know someone's looking to borrow at 15% on a first mortgage and someone else is looking for 10% and they're happy with that. And I can connect them and I can make a spread. I can't do that unless I'm a mortgage agent. Right now, I could borrow money, secured against my properties, and then relend it out. I could borrow at 8% and relend it out at 12 or whatever. That's something I could do. It's something people do. That's the business that I'm in, is like in real estate, we borrow money from the bank and then we put it into real estate where it generates 3 times that return. But the whole business that I'm in is literally borrowing money, investing it at a higher return, and then making the spread on that. In real estate, in business, that's all we do, is take capital and redeploy it more efficiently. So yeah, I am in that business and I do that. So if you do need a mortgage funded here in Ontario and you've got a flip or something, you want someone to fund it 100%, hit me up. If you got a good flip, you bought like 50 cents on the dollar and you're like, hey, I'm gonna do all the work, I just need someone to fund it, I could be that guy. The last question was, any update on your Florida ventures? Understood that Florida is a lot more attractive, but saw the status of values there also up 30-40% a year. Should one wait for the cycle to revert before investing? We're currently working on an opportunity, a couple opportunities in Florida right now. Sorry, my nose is itchy. Florida is attractive. It has a very attractive landlord and tenant relationship type environment to run a business. It's a beautiful place to be too. I think that it has great leadership. The state has great leadership, designed and focused towards freedom. The COVID thing is kind of ending though, so that could pull back on the state. Rents are going crazy there, again, which is a great thing in some cases. Excuse me. You know, I'm not confident enough to go balls deep, but I will continue to nibble on the right deals that make sense. But yeah, if I see market conditions improve, I will go really hard and do like 1,000 units in somewhere like Florida or Texas. I'm just waiting to see how these interest rate hikes affect the real estate market. I'm confident that in the fall in Florida, there will be a drop, and I want to ride that, especially in the multifamily space, especially in the multifamily space. The vacation rentals, there's a lot of international demand. It might not be as strongly affected as the large multifamily. I think there'll be a real opportunity there. So I'm waiting for that opportunity to arise, and I don't think we've seen it all yet. So I could be wrong. I don't have a crystal ball. But anyway, thank you so much everyone for watching, and we'll see you, of course, every Wednesday, 7 to 8 p.m. You know where to find me on Instagram, Mike Rosehart, and on Facebook. Again, Mike Rosehart. Look for the little blue check mark on Facebook. Yeah, that's it. The secret to unlocking wealth through you: spend less, earn more, and maximize returns in the difference. Thanks, everyone, and we'll see you next week. Bye, everyone. Have a good night.